Good morning, everybody, and welcome back to Beat the Bell presented by Kane Capital. Hope that you all had a phenomenal long weekend. It's been a minute since we've jumped on here together. The last episode was, of course, on Friday because the market was closed on Monday, but we're back. We're ready to roll. Hopefully, you guys are as well. A bit of a regime change early to start the week. This is the first real selling that we've gotten since the start of June. And to talk about it, we've got an awesome panel with us this morning, starting with Money Mander. Money Mander, good morning.
Good morning. Big day for the Bulls here on hump day. We'll see what they can get going.
Important day for sure. Diamond Trades, good morning.
Alejandro, good morning. Excited to talk about what the rest of the week has in store.
All right. And Matt is here to join us this morning as well. Matt, good morning.
Good morning, everybody. Thanks for having me.
Thanks for joining us, brother. All right, let's dive straight into Fed forecast and economic calendar with Diamond and Money Mander.
Yeah, for sure. Let's start with the economic calendar for this week. So we actually have a pretty busy week, not on the news front, but a lot of Fed speakers, as you guys can see. We've got 5 of them today, one of them being, or a few of them being the testimony that some of the Fed chairmen will give to Congress today. And then we've also got Fed Waller speech tomorrow, as well as the weekly jobless claims and another testimony by Jerome Powell, Fed chair, and existing home sales tomorrow as well, followed up on Friday with flash PMI, as well as 3 other Fed speakers. So in total, about like 10 Fed speakers this week in the latter half of the week. So definitely pay attention to that. They like to move markets with their comments. So that's something that we will be watching. The one piece of data that we did get already this week in this shortened week is the housing starts, which we can talk about. So housing starts came in yesterday, and they came in at a 21% increase on a month-over-month basis, which is significantly higher than that minus 1.2% change that was forecasted. This is the largest increase in over a year, the largest increase since of April of 2022. Home builders obviously gained on the news, continuing their hot start to the year, despite elevated mortgage rates. Names like Toll Brothers, KB Home, Pult Group have outperformed the S&P by 3x since the start of the year, showing no signs of slowing down. One place to look for an explanation is the active U.S. listings, which according to the Journal are down about 50% from 5 years ago, right? So the active the supply of homes, the amount of homes that are available to be sold, is down about 50% from 5 years ago. One of those reasons may be because a lot of Americans were able to secure low mortgage rates in the low interest rate environment in the last 3 years, and they're reluctant to sell their homes and either rent at an extremely elevated price or to take on another mortgage at a significantly higher mortgage rate. So a lot of people are just sort of sitting comfortable and waiting and not super incentivized to sell their homes right now. So the supply is down, and that may be why we can see existing or rather housing starts so elevated, much more elevated than anticipated yesterday. That's definitely something to pay attention to going forward. Yesterday's trading. So the markets kicked off this shortened week with a bit of a pullback, pausing a rally that really has pushed stocks to their highest levels of the year. The Dow led the declines yesterday, dropping by about 0.7%. SPY pulled back about 0.5%, and QQQ showed relative strength, dipping only 0.2%. The Q strength was notable, obviously with the 8 consecutive green week closes for QQQ. So has really just been chugging along. As Alejandro mentioned, this is really the first pullback that we've seen in quite a while, and we'll have to see if it can be sustained. The market really just appears to be consolidating ahead of Jerome Powell's comments today at 10 o'clock. So that'll definitely move markets and something that we want to pay attention to. Last thing I'll touch on is the Journal coping with the Tesla move. So in a sign of how aggressive this rally has been, the Journal yesterday posted an article titled, literally word for word, "Why Tesla's Stock Rally Doesn't Make Sense." That's when you know. Tesla is up about more than 150% since the lows that it set in October. Wall Street analysts believe one explanation for the rally could be investors attributing or the market actually attributing investor interest to the AI craze, with Tesla's stock price moving in tandem with the AI basket at different times throughout this year. So what they believe is that people are falsely attributing this whole AI hype theme cycle to a name like Tesla, which dabbles in the AI space with their FSD and a bunch of other things, but not primarily, obviously, an AI company. It is important to remember that while Tesla may be seen by many as sort of a next-gen tech company, which they very well may become here in the next several years, today they still make most of their money off of automotive sales, which have been doing well. Furthermore, Elon's announcement that he was going to appoint a new CEO of Twitter was a pivotal moment for the Tesla stock, as investors were able to sort of remove that overhang and were comforted by the fact that Elon's going to be able to spend more time at Tesla. So it kind of makes sense. Mander has been absolutely assaulting Tesla this year with over 100% trades to the upside. I would assume that they're all calls. Mander, what do you think about this Tesla rally?
Yeah, I think as far as the analysts go, I'll give my comments first. I think it kind of it's similar to like when we get news, and whichever way price action goes is the thesis of the news. But like that's what I think Wall Street's trying to pin here. But you can't discredit just a FOMO short squeeze here. That's really, in my opinion, more so what this was versus any positive tailwinds. I know they started leasing out their superchargers to, like, Rivian just announced they're going to have access to like 12,000 Tesla superchargers. Obviously, they're going to make money off that. But kind of coming off of like disappointing Q1 earnings after the price cuts, lower margins, I think this thing just got really, really oversold and trapped a lot of bears when coming into the start of the month here, or I guess it was really the end of May, it hadn't even taken out year-to-date highs when you had QQQ and the rest of the NASDAQ and a lot of those mega companies that it trades in tandem with taking out August highs, setting into new all-time highs, and you still had this thing trading at under $200, not even at year-to-date highs. So I think that's really what kind of fueled this more so than any actual news. I think you just had people taking profits out of Microsoft, people taking profits out of Apple. Well, okay, I want to keep it in Mega. I want to keep it in these names I know. Tesla's still at $200 here, hasn't even taken out the 217 year-to-date high. But yeah, just an unbelievable rally. It was actually 3 weeks to the day that I came on here. I brought up that Rocket Scooter monthly maps. I showed how bullish the positioning was. I was watching it on that daily bull flag breakout. The stock was at 198 3 weeks ago. And so it's up almost 40% in 3 weeks, like 75 points to the upside, really vertical. So incredible short squeeze there. I do agree with the sentiment. They do trade hand in hand sometimes with the semis and NVIDIA, but I don't think the semiconductor AI rally is what should be fueling Tesla. I think this was just a broader short squeeze. But the one thing I wanted to bring up while we have it on the subject here is similarly in this rally that we've seen for the first time in the past decade, and to my knowledge, maybe ever, equities, corporate bonds, and treasuries are all currently trading at the exact same yield. So if we take a look here at this graphic going back to 2013, the S&P 500 12-month forward earnings yield, the 3-month T-bill, and investment-grade corporate bonds are all sitting just above 5% here, which to a lot of people is begging the question, what is kind of driving this major rally we're seeing when debt instruments are yielding on a forward basis the exact same as the S&P 500 forward earnings yield? And so we kind of spoke about this a couple of weeks ago. To me, the answer is simply real yields, which is the only thing making this rate hike cycle any different and this rally any different than the previous counterparts that people are comparing to with 2000 and 2008. I keep seeing all these things about skew and QQQ and all this stuff going back to 2000. We haven't seen this, that, and the other since the 2000.com bubble. To me, the biggest difference here is real yields. Back then, you had a 10-year yielding over 3% on a real yield basis. With inflation right now, it's barely positive. It's pretty much at a break even. So to me, if you take last month's downturn in energy prices out, you just look at core CPI, it's still clocked in at 5.3% year over year and is likely to remain elevated for the foreseeable future because the labor force is just as resilient as they come right now. So I think to me, investors are seeking to take risk on in growth in tech. And really, you're seeing that, right? The growth risk in tech is really the only thing rallying. Now we're starting to see some breath go out into those smaller caps, into the Russell 2000. But for the most part, a lot of these names still aren't rallying. It's just that you're seeing investors put risk on into the names that have potential for growth instead of just locking in basically a break-even trade for a year if you got a 1-year T-bill. Well, this is what this did create. This created one of the largest divergences between stock valuations and treasuries maybe ever. I mean, you can look here on a 5-year chart, but I think historically maybe ever. We're taking a look here at the inverse overlay of the S&P 500 tech sector and the 10-year real yield. And you can see the divergence that the markets came. Because fundamentally, as real yields go lower, as federal funds rate goes lower, and then real yields go lower because of that, they even went negative here. You can see for a significant point, market participants become more risk hungry. because there's nowhere else to park your cash. If you're going to get a real yield that's negative and lose money in treasuries, obviously you're going to take some risk and put it in the stock market. Hence the massive rally you see there every time that real yields are negative. But right now, since this low was just put in, we've actually had positive real yields on the 10-year here, which you would think would run in tandem to seeing lower S&P 500. But you can see tech has just rallied through the roof off that October low set in while we still had real yields positive. So to me, this is kind of similar to that QQQ Russell 2000 ratio we put up. This is not saying that tech needs a full correction and it's going to fall to meet parity with the 10-year real yield there. To me, I think just as we look on a 12-month forward basis, as we start to see the Fed kind of unwind this hiking cycle here, that real yield is going to start to come down and likely catch back up to the forward-looking stock market here, which leads me to my last point here. If we look at the Russell 2000 and that QQQ thing we brought up about 3 weeks ago, playing out perfectly. The Russell 2000 out to a sizzling hot start to the summer here, outperforming the S&P 500 and closing yesterday's session up 6.5% so far in June, as we're finally starting to see that breadth expand from those 7 to 10 mega basket stocks that really started the rally here, finally starting to see that pan out into the rest of the Russell here.
Love to see that long Russell short tech spread trade idea of the year right there. We'll pass it back to Alejandro.
Great call on that one, boys. All right, we're going to go now over to Matt, who's got some rocket scooter stuff for us this morning.
Hey, what's up, everybody? It's great to see the market very resilient in this environment. I put together a video yesterday, actually, was talking about a new theory that I have. The way that we're looking at all the data coming through, it really does seem like the recession by a really small smidge could actually be over. Everything that you look for going into a recession, the data is slowly starting to turn. All signs are pointing like we're about to start an acceleration out of this. We have, GDP estimates are showing improvement. Unemployment filings, continual unemployment filings are coming down. There's the two major things that lead to a recession: unemployment and lower GDP. So those are both going the opposite direction, just slightly. And if you look at all the data positioning wise, the market is priming for the largest short squeeze it's seen since COVID. There is just insane amount of liquidity in the markets, which is stopping the sell-off from QT. We get that kind of finally realizing the maximum effect that would have on the liquidity now. The positional data and commitment of traders shows this is the shortest short we've seen in about 7 or 8 years. The hedge fund side against the market, and the market's not coming down. That short starts to unwind. What we see right now in the pricing of the index, especially the indices, could be the low for years. And if we just barely escape out of this because of the booming that we're seeing in tech, the AI boom, I'm calling it, this could be the exact perfect storm and recipe to pull us out of this recession. And I know last October I was talking about how the market could double up, double top, and then probably start coming back down in the summer. Now I'm looking at the S&P can aggressively squeeze from here, from this bubble that hasn't even gotten really big yet. And we could be seeing 500 by the end of the year. I know this is a little out there, but all the data is pointing to it. And not only is mechanically the market wanting to go up, is fundamentally the data is starting to look better week after week. So has the Fed achieved its goals? Yeah, I think so. I think everything's getting to where it needs to be. And this is a surprise to me as well. And so yesterday when I was looking at everything, it just started to, especially in Rocket Scooter, one of the last things that we saw, it's starting to really show that the market is becoming very comfortable here and that the shorts are becoming very nervous. The positional data as of last week shifted what we used to think was going to be a really near-term pivot in the markets, where positional data on Rocket Scooter showed late July for a potential market reversal. Now it's pointing at October. We got about 3 more months of bullishness and short squeezing still in the positional data that built out last week. So leading into monthly expiration, that sentiment drastically changed. So I think the market is going to accelerate and parabolically move up faster than most people think. And this is good to see because, we don't want to be in a recession.
It's a bold call to make. I think you're gonna make some people upset because of how hard we've already rallied to start the summer. But technically speaking, and this is something that I've been preaching on. So obviously, I do a lot of TA, and technically speaking, all of these breakouts that we've been getting have either back tested and held, or we haven't even come down to back test. And so this sell off, right? What are we trading at? 44.22 here. We're about 70 points off of Friday's high. Okay.
Mhm.
And what we see happen when we get these pullbacks is there's obviously dramatic shifts in sentiment, and bears start parading around. And it's important, whether you're using Rocket Scooter, whether you're using technical analysis, whether you're doing something else, to be able to identify the difference between a pullback, not necessarily as an opportunity to go long, but
Mhm.
understanding that technically nothing has changed, right? And that's what has gotten so many people in trouble over the past 6 months, is this attempt to short the top. And the opportunity cost of trying to do that can be massive, because
Mhm.
obviously we have rallied and rallied and rallied versus waiting for technical breakdowns of support, or in the case of you using Rocket Scooter, waiting for that positional data to shift bearish. And we know it
Mhm.
has. And it's
Mhm.
as simple as that. And so when you make a claim that we're gonna, rally through the rest of the summer and we can see a parabolic move, I want people to understand this isn't just an opinion you have. This
Yeah.
is, based on what you're seeing. And obviously, it
Mhm.
is an opinion, it's not a fact. Nobody can predict exactly what will happen.
Right.
But it's based on what you're seeing, right? It's not
Mhm.
you just saying, oh, the Fed, this, that, I think we're going to rally, because that's what people have been doing all year. It's, oh, the Fed, this, that, I think we're going to break down, and we're going to trade lower, without using any sort of positional data, which is the true advantage.
Oh, absolutely. And so, for me, I was kind of biting my lip when I said it. In the middle of me talking and teaching about some of the things I was seeing to people, it just started dawning in my head. Like, I had a realization mid sentence. I go, this market's not coming down. And I go, this could go. And I started mapping it out, and I was looking at where it could go to the upside. I
Do you
don't
have the
usually
map?
trade
Do
off.
you have the map? Would you be able to share it?
Yeah, yeah. I have my screen being shared right now. I'll show you the two things I'm looking at. So this is a really cool thing. I'm going to show you the commitment of traders really quick, because I talk about this all the time. This is the commitment of traders in the S&P futures. In the history of this report, when the market makers, which is this red line, were holding a net positive position, the market has never crashed under its own weight ever in the 20-year history of this report. So we've been sitting in an area where the dealers are holding most of the inventory as we've been selling to them. Let me go ahead and let's see if I got this. Okay, here. So if you see the other two lines, these blue and green lines here, these are asset managers and hedge funds. When they fan out from each other, it means more market participants. So the long is getting longer and the short is building shorter. The fact that it's got this fanned out shape means the market's extremely liquid. Anytime it fans out, the markets don't crash either, because they're not illiquid. Markets aren't volatile. And so the VIX crashing is a testament of this being liquid. And so the market is just too liquid to crash, and dealers are holding positive positioning. So that's the perfect recipe for the market to still go up, at least until dealers are negative. And then once dealers are negative, markets historically have never turned down until both the asset managers and the hedge funds are both selling at the same time. When these lines, the blue and green, are both sloping down, that's when you get downside in the market. Blue and green both sloping down, with the dealers negative, you slope down. With them fanning out, it doesn't matter what the dealers are doing. Markets will go up until somebody stops buying. If the buyers could be new longs or shorts covering, the market can continue to go. And I just forecasted how long it would take to wipe out a minus 600,000 short. This short is so large. It hasn't been this large since September, October of 2015. Even during COVID, the blue line was less short than it is now. Everybody's betting on a recession. And like you said, the opportunity cost is high. It costs a lot of money to maintain a short. So if that short stays short through worsening news, okay, it can sell once everybody is selling. But do you see people selling and people are buying? I mean, people have been buying since last October. That's why the market's rallying. If that market is not even that long yet, 755,000 net long contracts is not even close to the rally we've seen in the millions and pre-COVID rallies. So we're like halfway through the position that people comfortably can normally hold. And as economic data starts to improve, that pushing higher can squeeze the short. So when you unwind a short this big, that's the parabola you can get to go higher. And this isn't my opinion. This is just what you're seeing. If everybody's shorting this much against the market, you need a surprise catastrophe to have things fall. And we already had a bubble pop. It was called crypto. When the crypto bubble popped, it collapsed a bunch of banks, and the bigger banks bought them up. And the next day, it's like it didn't even happen. The market has so much resiliency here. I don't see any mechanism for it to collapse under its own weight, and neither does Rocket Scooter. When you look at this is positional data, and the easiest way to see this, this is a month out on QQQ, and this is what's really been pushing the rally. This dark gray area is bull side, this light gray area is bear side. And when the dark gray area is a lower low, as you see, over the course of time, this goes out till September, October of next year, or of this year. The distance between where the current price is and the bottom of the bull zone, you just see gets bigger. Bigger bull zone means more bulls. It means people are getting longer, which is exactly what Committed Trader shows in futures. So bulls are getting stronger and bears are getting weaker. So that big wound up short position we have there, the bears are walking away faster and faster and faster all the way through September as well. So you got genuine buying and shorts getting squeezed. So the evidence of the short squeeze is there, and the evidence of that wound up short in futures I just showed you. Once that starts squeezing all the way through October, we've got 3 months of parabola, and that's where I was going. And I saw that and my jaw dropped, because last October, when I said we were going to rally through the year and probably till the summer, now that the summer's here, people have been trying to short tops the whole way up, and we've survived bubbles. GDP is looking better, unemployment's coming down, inflation's stopping. Where's the bear thesis? And it just dawned on me. I go, there's a short squeeze, that this could be the low in the market. And it was exactly built off of that positional data. It's interesting to see that we might have barely escaped a recession, and that it's over as of this week.
Exciting stuff. The last thing I will ask you before we go into trade of the week. So we talked last Wednesday about we could still see a pullback in the market, of course. We're getting one to start this week. You are calling for a rally, but if we do pull back, when we do pull back as we are currently, how low, based on the positional data, do you believe that we could trade?
It's hard to say, because obviously, the stock market being random, all I can see is a position shift. The magnitude of how much people would sell off if it does, it's really impossible to say. To be honest, the only reason we're seeing a little bit of selling off, I would say, is because we just rolled into a new trading month. We had monthly options expiration, and this is one of those weird months where July started on a Thursday. So VIX expires its monthly after SPX, occasionally on a month's restart on Thursdays and such. So yesterday was the Tuesday before the third Wednesday, which is when VIX futures roll over. So we're in a new VIX futures contract, and there's a little contango built into it, but it's still trading at like 16.5. That's insanely low. For the idea that the market would pull back, you'd want to see some volatility. And the VIX came in nice and clean when we rolled over. We now have a new VIX trading month, and there's no volatility. I can safely say I don't think the market's going to pull back at all. We might see a little bit of selling, but there is no power here, and there's no volatility here. I would say that if we were to do any sort of pullback, I don't think that it's big at all. I think we might get 1 to 2 days down, and it's still going to see that velocity for a while. So I think this is just mechanics of rollover. And as the market comfortably sits after, yesterday and today, we'll see through the news and, Powell's talking, what the appetite is for this market. I really don't think I used to think we might pull back to maybe 4,300, 4,350. I honestly think that the new baseline is 4,450, and we're probably going to keep going from here until something brings us down. So I don't see a pullback this week or next. And Rocket Scooter shows the same thing. It shows a straight line move. So we'll see.
All right. Appreciate you as always, Matt. Great stuff there.
Yeah, thank you.
Thank you, sir. All right, let's go over to Diamond Trades. Noah, for trade of the week.
It's time for America's Trade of the Week.
Now, here's a guy who knows how to trade stocks.
Bentley might fly like a bird. Spin on the first and the third. Solid, I'm keeping my word. Can't be my equal, I don't know what you heard. Crank up the foreign, I swear. Keep me a stick if they.
So this was a trade from yesterday that we took, a very quick short trade in the morning. And so this was right when we came in. We saw ES rallying and NQ rallying as well. NQ was able to take that pre-market high where ES was not. That's what we call an SMT divergence. We love to look for those as a sign of the market tipping its hand, almost like a cracking correlation. ES and NQ are highly correlated assets, and so they should do more or less the same thing. When we see one of them make a higher high and the other one not, with clear liquidity targets below, that's a sign for us to get short. That's exactly what we did on ES yesterday before the bell, and we were able to capture about 11 points of that move to the downside before it ultimately sold 31 points. A really nice and quick move. These are the types of trades that we love as intraday traders, right? Not a ton of time elapsed from the entry to exit, not a ton of fighting with the entry. It was a clean one shot, one kill, get in, get out. And yeah, really, like I said, these are the types of trades that if you're going to be a discretionary intraday trader, that you want to look for, the trades that zip to your target very quickly, without a ton of fighting. If you're fighting the chop and you're trading through consolidation, that's one clear sign that maybe this is not the setup that you're looking for, at least the way that I trade. And so this was a really nice one that we had yesterday. The first time that I've shorted in a long time, really due to the positional data that we've got from Rocket Scooter and just really, how the market has been trading. And so I'm glad that, we were able to identify the short opportunity and take advantage of it, because there are so few of them these days. And when you do get a nice short setup, again, like this one, usually you can have, a pretty clean run to the downside without much fighting with your entry, with your stop loss. And the market really just works in your favor. So that's what we got yesterday. We were able to take advantage of it. And we'll see if we can do some more today. But yep, that's the trade from yesterday, and hopefully that's not the trade of the week. Hopefully, we got 3 days left here, guys. Hopefully we can get another trade of the week before
the only
week's
one we
over.
had.
Yeah, that is the only one we had. We'll get it. We'll have another one for you guys.
Mander's 80% or whatever on Tesla. Could have done that one.
We'll see where it can get to by the end of the week.
Yeah, we're waiting till Friday for that one, because he's probably going to be up like 600% on the trade. So we just got to be
dude. That stock doesn't go down, so I'm sure that will
not go down. All right, guys, that's going to do it for this morning's episode of Beat the Bell. Matt, appreciate you joining us per usual. Awesome stuff, high quality info. We will be trading live all day in the Kane Capital Discord. You can go to kane-capital.com to trade with us. We got a 7-day free trial going. I would love to have you guys join us. Hopefully you're all having a great trading week. If not, keep at it. Keep hammering. And we'll see you guys back here on Friday morning at 8:30 a.m. Eastern time. Have a good one, everybody.